If ever you've read an article about estate planning, you probably have read the term step up in basis, but still you might be wondering, what the heck is it? Well, here to talk with me about that is Harry Margolis. He's the author of Get Your Ducks in a Row. Harry, welcome.
To see you, Bob.
Good to see you. And it will be good to have you walk us through what a step up in basis is all about. What do people need to know?
So step-on basis has to do with capital gains and the tax on capital gains when you sell property. And when you're selling property, we're talking about selling real estate or stocks or these shares in a business or sometimes collectibles, artwork, antiques. Anything you sell, when you do, you're supposed to pay a tax on the capital gain. And the capital gain is the difference between what you receive for selling it and the property's tax basis. And the tax basis starts out as what you paid for it. And for real estate, there's sometimes adjustments. So if you bought a house and you paid $250,000 for it, then you spent $100,000 to build a new kitchen or an addition, sunroom, then the new basis is $350,000. So that gets added in because it's an additional investment. So that's one adjustment to basis. It's probably beyond our discussion, but some property or commercial real estate can be depreciated, and that also adjusts basis, which I have some policy objections to, but we won't go there today. But for most people, the biggest adjustment is what happens when you pass away. This, of course, doesn't help you because you passed away, but it helps your heirs. So if you bought that house for $250,000, and by the time you die, its fair market value is $500,000, at your death, the basis gets adjusted to the date of death value of $500,000. And then when your heirs sell it, they sell it quickly, so it hasn't the value hasn't changed again. They sell it for $500,000. They end up not having to pay any tax on it. And when this was put in place, it made sense in part because we had an estate tax at that point. So if your heirs were going to pay an estate tax on it, they shouldn't also have to pay a capital gains tax on it, the thought was. Well, for the most part, no one pays estate taxes anymore, except for the really wealthy, with the federal exemption now at $15 million, and husbands, wives being able to pass along $30 million tax-free, and most states having gotten rid of the estate tax. Almost nobody pays estate tax when they inherit property, but the capital gains step up in basis is still there. So it's also very helpful for estate planning and probate attorneys like me, because it makes the accounting a lot easier. Because very often, especially with stock that's been owned for a long time, no one knows what it was originally purchased for. Or if it was inherited, say you inherited 30 years ago, what was the value then? It can be hard to establish these things, so it's good to get kind of a fresh look at it. When someone passes away, we can establish the value then, and then we can know what the capital gain and the basis will be when that property is sold.
Yeah. So it seems pretty obvious that it's better to hold on to these appreciated assets versus selling them during your lifetime to avoid those capital gains. What assets, you mentioned a few assets that qualify, and some that don't, I would think would be like IRAs and 401ks generally don't.
That's right.
Fair? Yeah.
Yeah, because they're under a whole different tax regime. So they're tax deferred. So when you sell those, when you liquidate them, you have to pay income taxes on them as opposed to capital gains taxes. So capital gains taxes have their own schedule for what the tax rate is, and it's generally lower than the income tax rates.
So it would be best to hold on to your capital gain assets and to spend down your ordinary income assets.
Not necessarily. Oh, I mean, most of your IRA and 401k plans, you have to take your required minimum distributions anyway after you reach a certain age. So you don't have a choice in the matter. but often it really depends on where you are and what your tax rate is, because very often the income tax rate is going to be higher than the capital gains tax rate in any case.
So we just went through the one big beautiful bill. I don't think there were any changes to the step up in basis rules, if I'm correct. Is that right? There were nothing that can go effective.
No, there was change in the depreciation rules, which I had referred to. So you can get accelerated depreciation in some cases that wasn't available before.
Yeah, and at times there has been discussion about eliminating step up in basis, but we're safe for now. I think, right? That discussion around
Yeah,
that.
I think a lot of people say, well, then these people who have a lot of money, maybe not up to $30 million, but still millions, are getting away tax free. They're getting all this appreciation because they were lucky enough to own property and as the market was going up, perhaps through no skill of their own and or work on their own part. And then they pass away and pass it on to the kids, and they get it all tax free. And these are people already privileged, is the idea. They ought to pay some tax. Um, Personally, I prefer that they pay an estate tax, and we kept the step up in basis because my feeling is the step up basis helps everybody, not just the rich. And as I said, it makes my life a lot easier as a probate attorney in terms of bookkeeping.
All right. Well, I think we've helped people understand what a step up in basis is. Anything we missed or bears reemphasizing?
No, I think it's just something to be aware of. I guess one thing I'd say is in addition to probate, I do elder law, which has a lot to do with long-term care planning. And often we get the kids come to us and say, my parents should transfer the house to me in order to avoid probate and also uh, for long-term care planning. So so it's not subject to estate recovery if they get Medicaid coverage of their long-term care costs. And we're always uncomfortable with that because we want people to have control over their lives, control over their home. If they give it to their kids, it may work out fine, but it might not. And we're often able to convince the kids that this is not a good idea because we explain the step up in basis that they will get if they inherit the house. I guess this is something I should have said. If it's given to them as a gift instead, as an inheritance, then they don't get the step up in basis. So they receive it with the original basis. So again, if the parents paid $250,000 for the house and today could be worth $1 million, they really want the step up in basis so they're not paying capital gain on the difference of $750,000.
Uh, well, I guess that begets one more question. So, in some cases where a couple owns a home and one of the couple dies, the surviving spouse would get a step up in basis, if I'm not mistaken, right?
Or yeah, they would get a step up for half the value of the house.
Yeah. So
So
that could help
that can
too.
help.
All right, well, Harry, this is great. We gave some people what I like to say is we've helped them move from street level to curbside. So thank you.
Okay.
Appreciate it.